Hey, what's going on YouTube? Welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Moomoo. Right now, you could earn an 8.1% APY on your uninvested cash by using my link in the description below. You could also get up to 30 free stocks right now. Keep in mind, terms and conditions do apply. So go ahead and check out Moomoo. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. So I'll put a link to the Discord in the description below as well. Now let's get right into today's video. So today, I want to talk about a strategy potentially superior to the call credit spread. And so to understand this strategy, then we must first understand what a call credit spread is. So let's go ahead and let's start there with a call credit spread. So a call credit spread is a bearish strategy. So for today's video, I'm going to be using this stock right here, ticker symbol SNAP, SNAP, to take you guys through some examples. Again, keep in mind, everything I'm showing you here today is just that, an example. And so let's go into the options here for SNAP. And let's first discuss call credit spreads, and then we can discuss the other strategy here. So like I mentioned, a call credit spread is a bearish strategy, meaning you want the price of the stock to go down. And so let's say when it comes to this stock, Snap, we believe there's a high possibility that this stock will make a large move up or down. And let's say we're leaning towards it going down. So we're bearish on it. So again, we could implement in this situation a call credit spread. So let's say we decide to do that. So the first thing when it comes to a call credit spread in most other strategies is determining a expiration date to choose. So we want to go ahead and select whatever expiration date we want here. Ideally, we want that huge move to the downside to be made before our expiration date here. So let's say we believe this move will happen before March 7th. So then we could probably leave this as March 7th for our expiration date. Next, we want to determine what price we believe the stock will be below at expiration. So at expiration on March 7th, what price do we believe Snap will be below? Because again, we're bearish here. So let's say we think Snap will be below $9 a share at expiration. So then the first thing I'm going to do is I'm going to come in here and I'm going to switch over to sell here. And I'm going to stay on calls. And I'm going to start by selling a call at that price that we came up with. So we believe Snap will be below $9 at expiration. Then I'm going to start by selling a call at the $9 strike. So I would come in here and sell this call right here. The next step is we would come in and we would switch over to buy now. And now we want to also buy a call. And we would buy a call with a higher strike than the strike of the call that we're selling. So let's say I buy the call right above at the 950 strike. So I can come in here and select that one as well. Now notice, if you're on Robinhood, Robinhood will show you here what this strategy is. It's a call credit spread. And so when it comes to a call credit spread, we're going to be entering for a credit. So you can see the credit here. This means we would have to put up collateral. How much? For this example, we would have to put up $50 in collateral. And again, we're going to get a credit. We're going to get paid a premium here. And so let's go over to option strat here now. Let's visually take a look at what this trade would look like. So I'm going to go over to option strat. I'll put a link to option strat in the description below. This is a really great options visualization tool, and I'll show you what I mean by that. So I'm going to come into build, and I'll just start with a regular call here. And so now that we're in here, let's go over to the stock we're using. So today we're using SNAP. So here is snap. Again, the expiration date we selected for today's example was March 7th. We said we believe this move will happen before then. And then again, we said if we're going to use a call credit spread, we want to start by determining what price we believe the stock will be below at expiration. We said let's just pretend we believe it'll be under $9 at expiration. So we started by selling a call then at the $9 strike, so right there. And then we said we also need to buy a call. And we want to buy a call with a higher strike than the strike of the call we're selling. So I said let's just go to the one right above it at the 950 strike. Let's buy that call. So again, this is a call credit spread. This is also known as a bear call spread. And again, we're entering for a credit, which means we have to put up collateral. So we got to put up $50 in collateral. We're getting a credit or a premium in return. How much? About $43.50. And if we take a look here, our max loss is going to be around $6. Our max profit around $43, $44 here. We also see our break even here. And so if we actually take a look at this here, we can see what our profit or loss might be depending on the share price and depending on the date here. And we can also mess around with IV to see kind of how this might change with changes in implied volatility. But ultimately, we can see what our profit or loss might be here on a date and at a particular share price. Now, what's the problem here with this strategy? The problem here is, what if it does make that big move we're expecting, but instead of going down, it goes up? Well, as you can see, we're going to lose some money. If we actually take a look here, right, we would lose about 15% of our investment here. Let's say it does make that big move, but it just goes the other direction. It goes up. We would lose, again, about 15% of our investment. So how can we fix this? So now that we know how a call credit spread works, let's go back to Robinhood here. And let's talk about how we can easily fix this here. So we're still going to do the exact same thing we've done so far. So we're still entering this call credit spread here. But now we're going to use some of this credit or premium that we're receiving to help finance another trade. And what is that other trade? It's going to be a long call. So in other words, we're going to buy one more call here. And this call is going to have a higher strike than both of the calls that we have so far. And it should also cost less than the credit or premium we're receiving because we still want to enter for a credit here. So now let's say I buy another call here with a higher strike than both of the calls I have selected so far. Let's say I buy the call at the $11 strike. This is going to cost $6, which is less than the credit or premium I'm receiving here. So that should be fine. So I'm going to go ahead and add this here as well. And so as you can see, we're still going to put up collateral. Still going to be the same, $50. We're still entering for a credit. It's going to be a little bit less. But you can already start to see here how this trade might benefit us now here when we are expecting a rather big move up or down here. So now let's go over to a new tab here in Option Strat. Let's visually take a look at what this looks like now. So again, I'm going to go to build. I'm just going to start with a long call here. So let's go over to Snap again. And let's set up our call credit spread here first. So again, we're selling a call at the $9 strike. We're buying a call at the strike right above that, $9.50. And so now we said, okay, this is fine. But if it does make that big move, but it instead goes up instead of down, we're going to lose, quite a bit of our investment. So we said, how can we potentially fix this? By buying one more call. So let's add that call now. And that call was at the $11 strike here. So as we can see here now, still entering for a credit. Our max loss has gone up a little bit from $6 to $12 here. our max profit is actually now infinite to the upside here. And now notice we have 2 break evens here. So again, what's great now about this is that if it goes down like we expected it to, then that's fine. We still make our money here. But if instead of making that big move to the downside, it makes it to the upside, well, guess what? You're still going to make money here. As long as it makes that pretty big move, you can still make money now both ways, to the downside and to the upside here. Now, this strategy could also be very beneficial if you expect changes in implied volatility, in particular for implied volatility to go up a lot. So notice what happens here if implied volatility just goes up a lot. You'll start to see a lot more green. And this is expected because we're buying more calls than we're selling. When you buy a call, you want IV to go up. When you sell a call, you want IV to go down. Since we're buying more calls than we're selling, we would want IV to go up. So if you're expecting IV to go up, this could be very helpful here. The last thing I want to mention here is you can close out of this trade at any time. So you don't have to wait until it expires. You can close out of this at any point in time. I'll put a link in the description below to a video where I show you how to close out of any options trade on Robinhood. So anyways, if you have any questions, feel free to leave them in the comments section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think. Now I'll see you guys next time.